Hey there, my name is Hugh Kimura, and welcome to another episode of the Trading Lifestyle Podcast. Actually, this is going to be the last episode. I started this podcast back in 2012, and it's been a fantastic ride. I've had the opportunity to speak to a lot of cool traders, a lot of cool industry experts, but all good things do come to an end, and I sincerely thank you for watching and listening. It's been fantastic. But in this episode, the final episode, I had the opportunity and honor to sit down and speak with my friend Gonçalo. And Gonçalo is a wealth of knowledge on everything trading. And we got to talk on a whole bunch of different topics, including how he develops trading strategies, hedging, will the dollar fail, and much, much more. And if you don't know about Gonçalo, Gonçalo used to work at fxstreet.com, one of the largest Forex websites in the world. And he was doing a lot of different things for them. He was creating content, he was their primary hedging trader, and he was developing back-end software. So be sure to listen to this entire episode because there is a ton of information packed into this podcast. All right, here's the interview. All information in this podcast is for educational and informational purposes only and is not trading or investment advice. Hey, Gonçalo, thanks for coming on. I really appreciate it.
Hi, Hugh. Nice to see you again.
Yeah, good to see you. The last time we saw each other was at the London conference, I think in 2017, right?
Yeah, it was very long ago. Yeah, things have changed a lot in
Yeah, I'm
in the
sure.
Forex space.
Totally. So maybe you could tell people a little bit about yourself, how you got into trading, jobs you've had, stuff like that.
Well, that was already almost 20 years ago. And actually, it all began with a commercial transaction I was involved in
Hmm.
where there was currency risk. I was expecting a pay in nominal terms. I was expecting to be paid in euro, and suddenly I was paid in dollar. And there was already a difference. That was like 2003 or so. The euro was already trading above parity. And
Yeah.
suddenly I thought, well, how can I get this 10% back, you know? And I was already, as a European at that time, living the pre-euro area. I was already familiar with exchange rates and traveling within Europe, and we migrated from Portugal to Germany. So I was used to currency translation, but not to currency risk in that and in more professional terms. So that's when I first got interested in analyzing the foreign exchange market.
Hmm.
It was my my entry market was a foreign exchange, and luckily because later I found out that really the forex market is really the key to understand most of other markets, because the way it is built and the way it can be used to look at other markets from a local and global perspective. We can talk about this later. And at some point I decided to go for a more formal education. That's when I applied for the CMT association at that time, the Market Technician Association, to have a more formal education on technical analysis. There, you could find things through the internet, but there was there were things that a lot of the educational material that was available at that time was like a heritage from the 90s, from the stock, the dot-com era.
Hmm.
And some of the stuff was really not adapted to the foreign exchange market. So I thought, well, let me know the origins of all these theories, from Elliott wave to candlestick to oscillator work to and that's where I found things like behavioral finance and things like that. And yeah, that's how I got started in it.
Okay, cool. So for people who don't know, what is a CMT? What does that involve, and what do you learn in that?
A CMT is it's the designation meaning Chartered Market Technician.
Hmm.
It's basically those who analyze markets through data, price and volume foremost. Um, and But it goes beyond that. It goes much beyond that. In fact, you can also you can analyze any data series of. So if you have economic data, you can analyze economic data technically. You can even analyze a series of data which is not financial related. You can go to, I don't know, demographics or weather related, and you can treat those series technically in terms of momentum and direction, trend, and volatility, and so on. So technical analysis it's how you infer from data a series of conditions that are expressed through the data. It's like I like to see it as a low-cost form of market analysis. And in fact, it developed at a time where insider information was perhaps much more notorious than nowadays, and people wanted to participate in the stock markets, in the early stock markets where the dealing was done on the streets, and the earlier techniques, you see that there was this interest in through the data to infer what's happening. So there have been, and the manifestations and the findings, you can find it in different places around the globe at the same time. You have these paintings on the mine walls in South America and Chile, where the miners wrote down the prices they heard about of the metal being sold in London through the ships that arrived, and they drove the prices on the mine wall, and from the figures that evolved there, they could infer if in the near future, they would be paid more or less. So and you find these same figures like head and shoulders appearing in Japan through the rice traders and in many parts of the globe simultaneously. So there was already this awareness that data expresses something else, and that's the beauty of technical analysis. It's far more than just like a quantitative method of analysis. It has a qualitative side as well. I see many futile discussions in social networks whether TA works or not, and most of them focus on the quantitative side only. They want to make a very strict science of it, and in fact, it has a qualitative side of it. As an example, because otherwise this becomes too abstract. Let's imagine you have a price, or you have a chart where you have an all-time high, like Bitcoin, all-time high 2017, and you have a descending trend line. You have a series of lower highs afterwards, and you can draw a descending line from those tops, from the very top and subsequent lower swings. And that trend line, once the market hurdles that trend line, it can be an insignificant breakout happening years later on, even with a lateral movement. At some point that line is broken. That breakout has a significance because of the origin of the line. It's a trend line that comes from a very from an all-time high. So the significance of that geometry on the chart carries that significance. It is embedded into that geometry on the chart, the importance. So it's different than a breakout from an interim line. And this is just a small example of this qualitative aspect to technical analysis. Or you take, for example, an index, a stock index, and you translate it into a basket of currencies, and suddenly you see a different behavior. You might have a big correction happening in the Dow Jones in dollar terms, and you think that's what everyone is looking at, but perhaps most of the globe is looking at that index in terms of their own currency. So for Europeans or for other people on the globe, they are translating that price action into their own language, I would say, their domestic currency. And suddenly that huge correction is not as pronounced as in dollar terms. So these are ways to use technical analysis to extract a meaning out of the data that qualitative aspect into it. So a CMT market technician or a pure market technician works with all this data that can, as I said, go beyond just price and volume.
Oh, that's amazing. That's awesome. You think a lot of the hedge funds get into this stuff? I think that more of the retail market, they just look for like the flag or the, you know, the breakout or whatever. But do the hedge funds, do you think, go deeper than that and look into this kind of stuff?
Well, I'm not sure about it because sometimes you see huge failures happening because of this misunderstanding in relating markets to each other. I think most of the prop trading companies, and they go more on the hard side of things and on the quantitative side, and getting an edge from speed or from volume, but really understanding markets in a global way. Well, there is surely awareness of that, but I don't see that is as mainstream as it could be, and the fault is in the end relies on in the hands of analysts themselves, and what we do with this knowledge body we call technical analysis, how we teach it, how we communicate it, how we use it. There was a time when looking at a chart and spotting a, I don't know, flag pattern or so was an advantage. Nowadays, I mean, perhaps you have to go a little bit further and see if that flag finds some correlation to a proxy market that expresses something similar, or looking into the mechanics behind the chart and see if how is liquidity. And I think you have to go a little bit deeper, but without losing sight of that markets are interrelated. That's something that we should never forget. That even if you are in, or especially if you are in Forex, I mean, you can't see things isolated. Forex is basically the dollar against everything else. It still is, and it will be for a while yet. It's the dollar against everything else. And all other markets are related. If a price goes down, somewhere something is going up, because the money doesn't evaporate like that. Money moves, capital moves from one side to another. So there are ways to find capital flows. And from capital flows, you can infer history. You can infer the news, what's actually happening. If you see a lot of, I don't know, military equipment companies going up suddenly altogether, there is a meaning behind it. If you see a country like China dumping US bonds, I mean, or swapping it for short-term treasuries in volumes like never before, there is a meaning into it. You can infer things that are happening in the world through the observation of capital flows. So there is more into technical analysis or market analysis in general than just investing. There is also an understanding about other dynamics happening in the geopolitical space and so on that can be very, very helpful. And then, I mean, we could go to topics like, I don't know, if you're looking to buy something at Amazon, you could follow up your desired product. You could treat that data technically. You could ask Amazon to specify the price movement of that particular item in terms of volatility, in terms of momentum, to find the exact moment when you purchase that product. Because you may have a discount that happens once, but if you have two discounts and the second discount is percentage-wise higher than the first, there is an acceleration, there is a momentum. So there is a meaning. I mean, they are decreasing the price, and percentage-wise, not price-wise, percentage-wise, because 10% of 3,000 is one thing in nominal terms, but 10% of that, after that 10% reduction in terms of nominal is higher. So there is an acceleration, right, in terms of nominal, but there isn't in terms of percentage. But if there is, there is an interpretation. They're reducing the price at a faster rate while we decide to buy. So you could go on and treat data of all kinds technically to find to make decisions how to buy a home, the car, or whatever. No, yeah, that would be interesting.
Yeah, no, totally. If people are interested in that, there's a couple companies that actually will chart the prices of individual things on Amazon, so you can take a look at that and see what the historical price is. It's pretty interesting. You bring up a good point, though. I want to ask you about this. Do you think the dollar is going to go away in terms of being the reserve currency in the near future, or is it going to take a while for that to happen?
I think being the dollar, the global de facto currency, in order for that to go for that position to be abandoned, you have to have an alternative, right? And history shows that when there is a collapse in a monetary system, usually the currency that collapsed last is the central currency, is the stronger one, the stronger in terms of trust, not in terms of its relative value. Okay, so I think it's something that not everyone thinks about, that we may get even to the situation where the dollar is dethroned from its current central currency or reserve status, but we can have a very high dollar at the same time. Okay, so these are two different things. One is the exchange rate and its value relative to all other currencies, and the other is its role, right? And in my view, there is not yet really an alternative, and that's basically because of the size of the American market as a consumer market. Everyone wants to sell to the US. So in the end, they have to pay with dollar. So they have to exchange to the dollar to pay. So and it's not in the interest of many countries to just to change things, because it's something that perhaps it's difficult to understand, but the dollar is not just the domestic currency for the United States. It's a global currency. It's a currency that a lot of debt is issued in dollar terms. I mean, there are a lot of countries that issued debt in dollar terms. This is something that can be done. So it's for the Federal Reserve, the monetary authorities in the US. It's a tough position to be in, because you have to deal with domestic decisions when you move interest rates, but at the same time, you know that by changing monetary policies, you are impacting the entire globe, right? So I don't see that happening in the near term. We don't have an alternative yet. We don't have an alternative with the euro. The euro was created at that time. It was promised. I can remember friends were studying economics at that time in Germany, and there was a widespread view, at least in the academic sector, that the euro would never work. Really, it would stay as a synthetic currency because they were not to consolidate the debt. So what simply happened, they transferred the currency risk from the currency market to the bond market, because that risk is nowadays, or since then, played through the bond market, where each country still has its bonds, the Spanish, the Italian, German, and so on. So that was never consolidated. So without a consolidated debt market, you don't have the depth of market to park money in the euro. Where you want to park, you park in German or you park in Italian. And the problem with it is that once you have a problem with one country, with the debt of one country, you have a contagion happen, because everyone is going to ask who is next and who is next. And then you have a contagion happen, like we already had in 2010 in the euro area. So the euro doesn't serve as an alternative. And I do not have yet viable alternatives. So I don't think that it's more of a political talk right now than something that can be. But we'll probably see that. But once the dollar is dethroned, then everything else is already. I mean, trashed away. The euro, I mean, for the dollar to collapse at all, I mean, what should happen to the euro? It's the euro should be already gone long ago before the dollar, at least in the form that we know it nowadays.
Oh, okay. Great points. Yeah. I also want to talk to you about your experience at FX Street. You were there for a while. It's one of the biggest Forex websites in the world, if people don't know. How was that? I mean, that must have been great working at such a big website, right?
Yeah, that was great. I started there in like, I think at the time when I started, I ran a small website, a Spanish-oriented Forex website, and I was a heavy user of FX3 at that time, giving them a lot of feedback on their website, and I was lucky enough to be living in the same city where the headquarters are in Barcelona, Spain. And well, just it was a matter of time that at some point they asked me to be involved in a project, an educational project. At that time, I started as a freelance, and later on, they wanted to have a specialist within the team. And that's where when I started, and then the roles I did that were very diverse. I went from delivering content to mentoring. Then we developed a lot of tools. Some of them are still working today, others not. They were really cool projects. And in the end, we had this idea to go into trading and have a live trading room where we traded in front of customers, and that was the last project I was involved with. But I think it's for people listening to us. I think it's interesting to think of the variety of jobs that can be associated with financial markets, with trading, because many people think that or see that their approach to financial markets, the only way to make money from it is through trading, and there are lots of other venues. It's you should see what is your experience, what are your skills, and because there are a lot of things that can be done within the industry. If you are good at writing, you can perhaps go into more writing financial content, or if you are able to translate, you can become a specialized translator for news and analysis, which is a very high specialized job. If you are more of an engineering mind, you can go perhaps into tool development or platform development and things like that. Or if you are more risk oriented, a professional risk manager, perhaps something for you. It's in high demand. So there are a lot of ways to live from to earn your living through financial markets, not only through trading. Perhaps we have this idealized view of, well, trading the markets, be independent, and all this idea. But in the end, perhaps you have some talents that you can bring to the industry that you can't express solely through investing or through trading. So it's good to diversify.
Yeah, no, that's a great point. I personally I don't have a finance background. I have a biology degree, and I got a job at a hedge fund, at the trading desk, doing Excel basically, right? Just doing the reports and all that stuff. But it got me into the environment. It got me into a place where I could learn. I could learn from real traders, and there were like literally billions of dollars going past my desk every day, and I didn't have anything to do with finance, so that was just a great way to, yeah, like you say, earn some money, earn a living while I was learning about trading and being in that environment. So yeah, that's a great point.
Exactly.
And a lot of people think that you have to quit your job and like become a trader, but no, you can do some other things too.
Exactly. And I saw a lot of people coming from all kinds of backgrounds, and I saw a lot of people coming from music,
Oh,
musicians.
interesting.
They are very good at pattern detection, very good with harmonics, and they have a special understanding of markets, that are sensibility towards markets that perhaps other people won't have. And I saw people coming from the design world, photographs, and also working very very good with charting, with the geometry of charts, because they look at a chart and immediately they see the geometry, they see the proportions, and also it's good to delve into yourself and think what I can bring to the space. If you are into biology, you are used to complex systems, you're used to chaos, and so you are used to find an order where perhaps there is no order, or to the how different systems combine and into a bigger whole. And so that's something that you bring to your understanding about how things work. Definitely.
Yeah, no, totally. So yeah, I mean, related to your work at FX Street, we were both at the Truth About FX conference, and you talked about hedging, and you used to do a lot of hedging content on FX Street. And I really want to thank you for that talk you did at the conference, because it really inspired me to continue hedging. And I saw that you were doing it successfully on the website, and it really helped me push through some of the roadblocks that I had with hedging. So maybe you could talk about like how you got into hedging. I think you did some research on people who won trading contests or something like that, right? And they won a lot with hedging.
Exactly. There was I did a lot of reverse engineering at that time, after observing a lot of traders. And I got interested in knowing and analyzing or at least I was long enough in the industry to see the ones who survived the test of time. And one of the things that I observed was that the ones that were in the end alive after a while were using, well, not exactly, they were not exactly hedging, well, although some of them, yes, but the point was that they were using either they stopped the short-term approach to markets and went into more position trading, long-term trading, or the ones who stayed within the day trading activity, they were they didn't go with this common belief that you have to use an asymmetrical risk to reward ratio in terms of risking a little to go for twice or more of a potential gain, and all this typical 3-to-1 risk to reward. So I saw that they inverse this relationship. They risked a lot more, and that's where I saw things hedging being used where people were not using stops or close stops in their trading. They were using stops as just a means of controlling risk in case of a very price going havoc and I mean blocking your account from a margin call, but not actively using stops as or stop loss orders as part of their strategy. They inverse this relationship, and this is something you can observe. I mean, the closer you have an order, be it an entry order or an exit order through a take profit or a stop, the closer it is to the enterprise, the faster it will be hit by market forces. And that is especially true in the Forex market, by the way, because the Forex market is essentially bidirectional market. It doesn't have this upside bias that other markets may have, like stocks, for instance, where they exhibit different behaviors if they go up or down. Usually it is said they go up the stairs and down the elevator stocks, but you don't see this in the Forex market, because in reality an exchange rate, it's not a price, it's a ratio, right? You are measuring one currency in terms of another, and as such a ratio behaves differently than something that you price, a commodity or so, where you have an asset and a currency. When you measure currencies, it basically what you're looking at is at a relative strength study, like the gold-silver ratio. Look at the gold-silver ratio, and it behaves, it oscillates a lot more. Obviously, there are times when distortions in financial markets are very pronounced, and the ratios go off their regular limits. But otherwise, they stay within this oscillating behavior. And this oscillating behavior can be seen fractally also in the very short term. So especially in the Forex market, hedging or strategies where you do not use close stops are very effective, I think, because there is rarely a price that is touched once and never again, or for a very long time, not revisit by market forces. So unless you pick the very top or very bottom. So this makes the use of asymmetric ratios very useful, and also the use of hedging. But this we have to see also that hedging is not replacing a stop loss order. So because if you are in that situation, then it changes. You can go into big errors. But that's what I observed, that at that time there were people, traders, users of FX3 at that time, where we organized some real money trading contests where the winners were basically traders who didn't use stops or very wide stops, very short take profits. So obviously, when you invert this, you increase the win rate very rapidly. Then it's you have to obviously think that well, if you increase the win rate, you will decrease the average win, average loss. So that is where you have to pay attention to, that once in a while you have a loss, and that loss has to be compensated by that higher win rate. But that's definitely possible.
Yeah, I've heard that a lot. So basically, they're just putting a catastrophic stop loss in there, right? And then even if it doesn't go their way, they can just hedge it, and it might not even hit the stop loss. Is that right?
Yeah, and hedging basically, when you think about hedging, it doesn't necessarily have to involve the complete hedge of your entire position.
Mm-hmm.
I mean, you can be partially hedged if you, especially in the forex market, if you have at the same time two different setups, or you are capitalizing on one setup, you go for 100 pip target, and while that trade is running, you spot another one for a shorter in a shorter time horizon. You may be exposed to different directions at the same time. So at some point during the duration of the first trade, you'll be hedged fully or partially. But that is where hedging becomes interesting, that you can combine different setups. Now, opening a trade or a position in two different directions at the same time, I don't think that kind of hedging makes any sense. The other problem is when you use hedging, and I think all of us went through this experience, to hedge a position, a losing position, at the worst possible price level or moment, where you hedge a position because you don't want to face the reality of liquidating and accepting that loss. In the end, we are wired to let losses run and take profits too soon. That's the way markets in general work. And also on the institutional side, we see that happening, and that's one of the reasons why we have this behavior, this oscillating behavior, and this constant spikes and ups and downs and cascades of stops, and that's because of this behavior. You are in a trade, the market suddenly goes against you, you hold that trade, and at some point you can't stand that trade anymore. Either you are forced to liquidate. Let's say you are short a market, the market goes up, and that sell trade goes in the red more and more and more. At some point, you are forced to liquidate through a margin call, or you stop out. By liquidating a sell, you are effectively buying, right? Mechanically, this is a buy order. Once you buy, to get out of a sell, that buy order will mechanically observe liquidity that is available to sell. You'll observe that. And by doing that, it ticks a little bit higher, observes sellers that are a little bit above. So the price ticks higher, and other players will go even more into the red, be forced to do the same thing. And so you have these spikes in both directions. So at some point, you don't have anyone more wanting to buy. You don't have more buyers that were in fact sellers opting out of the market, not buying because they want to enter. They buy because they want to exit. At some point, that liquidity dries, and if you buy the market there with a hedge, you sold down there, you buy at the top, the market at some point fills the vacuum, the liquidity vacuum that it leaves behind, and suddenly you have a sell trade in the red and a buy trade in the red, and you have a huge zone where you are losing on both sides, on both legs. And to get out of those two trades, the market will have to swing above and beyond those limits in order to get out with a profit on two legs. And that's basically psychologically that's unsustainable. You will at some point freak out and close everything. And so never use hedging that way. It's advisable to have those, to never enter a trade in the direction when you have an overshoot in the price, because if there is an increase in momentum, There are probably a lot of people that are freaking out at that moment. So don't jump in the same direction as the market. So don't hedge at because it can happen that you hedge at the very top or bottom, and it takes a long time to go back there. Really use hedging as either because you spot a different setup and independent from other setups that you are capitalizing on, or you really have a directional bet. You don't hedge because you are not able to, or you are avoiding to liquidate a
Mhm.
loss. So have very clear levels where you know that your setup is no longer valid. You go out and look for another chance.
Mhm. Yeah, I think
That
we've
would
all
be
been there where
my advice.
we've hedged like we've had a really big hedge and can't get out of it.
Yeah.
Yeah. So did you notice any patterns in terms of like entry setups? Was there any particular entry setup, or was it kind of all over the place? I would expect it to be all over the place, but I don't know. What would you see?
Well, can you repeat the questions too? So, excuse
In
me.
terms of like entering the trade, the first trade, did you see any patterns in terms of a particular system or anything that where there was a pattern, or was it kind of just all over different entry setups?
Well, I saw a little. I saw and I experimented with a bit of everything, with
Mm,
momentum and with mean reversion. Mm, I found that at some point, when you are long enough in the market, you have your preferences. Personally, when trading the forex market, I like to trade back to the mean, where I like
mm,
to go enter the market against the that pain level, when I can infer from a price action that the majority of players in that situation are experiencing some pain. I want to offer liquidity by going feeding the market, uh, and in a way that I know at some point I will be compensated.
mm,
But there are players out there that prefer go into momentum. They see the market is overshooting and they go for that, and they capitalize on that,
mm,
on that liquidity burst, and for a few points. So you have to find out where what's more akin to your profile. Personally, I like to go to capitalize to on the on the reversal to a central value of some kind.
mm, mm,
I find it especially useful in some forex pairs that are where you have highly correlated currencies, and uh, I find this out coincidentally that using the euro franc, I always thought of the euro and the Swiss franc like two boring currencies. But once I found out that the cross of these two currencies was especially useful trading mean reversion, then it's I basically specialized in this pair. I started trading a lot more of this pair
mm,
compared to others, because you have two currencies that are highly correlated. When you measure the euro against the basket of currencies and Swiss franc against the same basket of currencies, uh, they they move practically in tandem. But from time to time, you have one or the other deviating from this correlation, and at some point, either the one will catch up and reverse back to that correlation, or the other will do it. And this in the exchange rate, this is expressed through a reversal.
mm,
So if you have observed the euro Swiss franc in on the intraday charts, you have a lot of these bursts outside of the normal volatility, and most of the time they reverse. So from here on, you have to find which is the chunk that you aim to obtain from that reversal, and what kind of tools you use, right? But as a concept to build a strategy upon, I think it's interesting for mean reversion, and this is where the building of a trading methodology becomes something more, let's say, significant in terms of you detect, you make an observation, you start from observation, you build an hypothesis, and then you look for the tools to measure and capitalize on that setup. This is different than just going straight to the tools, to the techniques, and try out, let's see what I can get. No, I'm like, take an oscillator, let's see if I can use it to make money. Instead, if you know the nature of indicators, if you know the nature of certain techniques, then once you have an idea, you start looking, okay, now I want to do this. What do I need to measure and to capture this? I have a highly correlated pair. So now what do I need to capitalize on a mean reverse? So let's think, well, perhaps I need to build a synthetic pair out of the euro, out of the Swiss franc. I start to measure these two synthetic pairs against each other, which will basically show me a similar picture to the pair in itself, to the euro Swiss franc pairing, but I will construct it for independently of the price that I see. Then I start measuring perhaps volatility, okay, or momentum. I will start measuring momentum extremes. While I grab an oscillator, what kind of oscillator? Do I need something like an RSI or something more sensible like a stochastic? Knowing the nature of these indicators, this is something for another discussion, but it's really useful to know why these indicators were developed in the first instance, because in the end, what they do, these indicators, generally all technical indicators, they translate the price action into a different data series. And if you don't know why they were created in the first instance, you will never be sure when or for what to use them, right? Because if they were created because there was a need to extract a certain or to isolate certain information out of price. Otherwise, you look at price alone, right? And there are also a lot of discussions out there about if using indicators or not, and we know that indicators are derived from price action, and everything that indicator shows is within the price. Yes, it is. But if you want to extract an information that is hard to see by looking with a naked eye in your chart, then it's absolutely, I would not say necessary, but at least it is understandable that you transform the price series into something else to extract that information. There is when you can get an hedge. I don't know if we get too far off.
No, that's good. That's a great tip on the Euro Swiss.
Talk about indicators in another episode.
No, that's a great tip. Thank you. And it really gets back to what you're saying in the beginning about being more qualitative instead of quantitative, right? And just kind of looking at the relationships instead of just the hard numbers. But where can people find you if they want to learn more about hedging or astrology or trading or whatever?
Well, I'm mostly active through LinkedIn these days. I'm working on a personal project right now. It's called vocabta.com. It's a website. It's basically a phrase bank that is made for analysts and people who want to become financial writers. And it's a phrase bank containing specialized vocabulary for technical analysis. So there are dozens of ways to say a market goes up or a market is becoming volatile. There is a breakout. There is this and that. So there are expressions in English that are also imported from other areas, from other from popular knowledge, from other languages, and it becomes very interesting. And I started collecting these phrases early in when I started learning at the MTA. Also because English was not my mother tongue, so I needed to, or I wanted to avoid sounding redundant when expressing myself in English. So I started a small phrase bank or synonym list, and that over the time that grew to the thousands of expressions that are almost I don't know, near 4,000 different expressions over 100 more or less 100 topics for technical analysis. And I put this online on a website, and it's aimed for either non-English analysts or younger analysts wanting to diversify a bit their knowledge. So I'm a lot of active now with this project that will launch soon. It will be a pay-per-view access, and I have a small YouTube channel associated with it where I put some here and there some ideas. But I'm basically more active in LinkedIn. So if someone wants to contact me through LinkedIn, that's okay. If someone wants to, I don't talk a lot about astrology in LinkedIn. I'm not sure yet how to approach that
Yeah.
area in LinkedIn,
Yeah.
if using LinkedIn or a different venue. But if someone wants to have a consultation, can find me through LinkedIn as well.
Okay, great.
And
I
I
appreciate it.
appreciate a lot of
I'll link
your.
to all of your pages in the show notes so people can find you. But again, I appreciate it. This has been a fascinating conversation, and thank you for taking the time out to talk to me.
It has been a huge pleasure, Hugh, and I hope we can repeat it. There are a lot of topics that we'll have to on the table on technical analysis and such. So anytime you want to repeat, I'll be available. It has been a
Okay.
pleasure.
Yeah, fantastic. We got to do this again. All right. Thanks, Gonzalo.